Good afternoon, and thank you for participating in today's live webinar, exclusively available for BMO InvestorLine clients. My name is Sarah Hansen, and we have a very special guest speaker today, Jason Ayers, Derivative Marketing Specialist from the Montreal Exchange. Today, Jason will be discussing common trading mistakes to avoid when investing in options. To ask a question at the end of the webinar, please hover over the top of your screen. A toolbar will appear, and then click the Q&A button. I will now pass it on to Jason to begin our presentation.
All right, fantastic. Thanks very much, Sarah. Just a quick confirmation to make sure that the audio is working at this point on my end. If we could just get a little acknowledgement in the Q&A box, that would be fantastic. It's an absolute pleasure to be joining you guys this evening, and what a fantastic turnout. The numbers are just ringing up here as I speak. Good stuff. Looks like the audio is working properly. This is, in fact, my first opportunity to be presenting to BMO clients, and it's a great honor. We've been educating on behalf of the Montreal Exchange for about 4 or 5 years now, and I'm in fact a derivatives market specialist, not marketing specialist, market specialist by designation. So we trade and invest our own capital and work very closely with the exchange, just bringing practical insights and trading ideas to inspired retail investors across Canada. So today's a really great presentation, I feel, because it really does sort of lay down some of the mistakes that, in fact, I had to learn the hard way in the beginning, and hopefully some of these insights can maybe save you guys from doing the same thing. So we're going to look at options trading mistakes to avoid, and I just want to make sure that I do indeed have control of the slides, which it looks like I do. So you guys should be seeing here the agenda for this afternoon's presentation with a little rundown on some of the typical mistakes that you can potentially run into as you're starting to embrace this market. First, as you'll see, is relying solely on market timing. The idea that it's all about the stock, whether it's whether you're looking at it fundamentally or technically. We want to recognize that there's many other considerations when you start to integrate options into your portfolio. The idea of using an all-purpose strategy in all market conditions, one of the greatest benefits of integrating options into your approach to trading and investing is the idea that there are many different strategies that offer you the opportunity to take advantage of all sorts of market conditions, so you want to pay some close attention to that. The idea of buying bargain or cheap options, looking for the cheapest option that you can buy, believing that cheap is better, but failing to recognize why those options are in fact cheap. Ignoring implied volatility, which I believe is a very important consideration, and there's some lessons to be learned there if you haven't already learned them. Disregarding earnings and dividend payment dates, the age-old challenge of waiting too long to close your positions, whether it's holding on to a loss or whether it's locking in profits. We need to make sure that we take action when our plan suggests to do so. Speaking of plans, failing to plan an exit or repair strategy when you are in the midst of a position. And finally, compromising your risk tolerance to make up for past losses. So we do have a lot of information to cover this evening, and just getting a suggestion that there is in fact no video through the chat box here, and I don't know whether that is a challenge for just an individual attendee or it's something that everybody is dealing with at this present time. I've only had one person indicate that, but I'll leave it up to the folks over at BMO there to take a look at that. But perhaps you just need to make sure that you have clicked on the appropriate window that houses the presentation, because sometimes the presentation will open up in another window. So if you actually have a window open, check that out. Yes, some folks are having some challenges with that. So just look at your tabs at the bottom of your screen and click on the other one that indicates the one that indicates the presentation, and it should pop up. And perhaps one of our folks, maybe Sarah, you can kind of help folks out with that as we move forward. So I'm going to just dig in here and take a look at the first challenge, and that's relying on market timing. And so once again, we have to recognize that there's a lot of different reasons why we may want to take advantage of an opportunity in the markets, and it could be technical if you're somebody that adheres to a technical analysis approach, looking at moving averages, MACD, stochastics, price action, pattern identification, that sort of thing, or whether it's fundamental, whether you're looking at the forecasts and PE ratios and so on and so forth. So it really doesn't matter what your expectations are. Really, the fact of the matter is we want to recognize that there are a number of different variables that influence the options premium. Now, again, guys, I'm actually getting some folks suggesting that they don't have video, others that do. So I'm thinking that it might be something on the individual's side of things. So just poke around with the buttons, the windows. All right, good. Everybody's looks like they're getting it. Perfect. Okay, guys, great. So again, the mistake is overlooking the other variables that influence an options premium. And so what I always try to just suggest to folks is that learning the options market can be a little overwhelming at first. I may be stating the obvious here, but there are a number of different pricing variables that influence the how an option contract is priced. But we want to recognize that it's those different variables that actually give us the flexibility, and so we need to make sure that we pay very close attention to them. So we want to understand that option premiums will not reflect the exact move in the stock because of these different variables. And remember that we are dealing with a derivatives market, and if we understand that the word derivative means that we're looking at a particular financial instrument that derives its value from that of an underlying security. So the option contract will, in fact, trade very closely to the underlying security, but will not reflect the exact move. And that's because not only does the price of the underlying have an impact, but the strike price of the option contract and its relationship to the price of the underlying security, the time until expiration, the volatility of the underlying, and by volatility what we mean is just how significant the price of the underlying security, the stock, moves on a day-to-day basis, and the more volatile the stock is, typically the more expensive the option contract is, as well as all dividends and interest rates are factored in as well. So we tend to pay very close attention to the first four because on any given day, these are the variables that tend to be changing throughout the day, every single second of the day that the stock market is trading. These options contracts are being adjusted by those four top variables, and of course dividends are already priced in, and we can find the date on which a stock is going ex-dividend to recognize when there may be a little bit of an adjustment taking place. And the risk-free rate of interest, of course, does not change that regularly. So top four become the most important ones to consider. Now, what we want to understand is that many investors are attracted to options because of the fact that they can leverage their capital with a limited risk exposure. They can use options, a number of different option strategies for protection. There's many different strategies that allow us to generate income, as well as just the flexibility of being able to take advantage of, as I mentioned earlier on, any market environment. But we want to understand once again that the options market have very unique trading characteristics that are significantly different from what you might be used to as a typical stock trader or an investor. Now, I don't mean to sound, I don't mean to scare anybody off by that, but what we want to recognize is that we are dealing with a different market, and we need to pay attention to it accordingly. Part of the challenge with that is really recognizing which opportunities or which strategies are appropriate for which opportunities. You know, I remember when I first started really just looking at one strategy and just, you know, thinking that, okay, this is the best strategy to utilize and it doesn't matter what's happening with the stock. If I'm bullish, I'm using this, and if I'm bearish, I'm using that, and that's all there is to it. But as I evolved as an options trader and I began to understand, you know, how these different variables will change depending upon the market environment, I recognize that, you know, there are a number of different strategies that are appropriate for different circumstances. And so what we want to understand is that the first priority is really what are you trying to accomplish, not what am I trying to accomplish or what your neighbor is trying to accomplish, but what are you really looking at accomplishing by integrating options into your portfolio? Are you looking to generate cash flow? Are you looking to hedge risk? Are you looking to leverage capital? You know, and from there, you can start to hone in on specific strategies that will allow you to achieve those different objectives. And so once we understand the dynamics of the options market, we can step back and we can construct a strategy to meet any different objective that we may very well have. And so on this particular slide here, what we have is just a simple list, and this is by no means all of the different strategies that are available to you as an options trader, but just a few select strategies that you can consider under different market conditions. So if you in fact have a directional bias on the stock, if you're bullish or bearish, you could just go long a call. So by long a call option or a put option, I mean you are the buyer of that option contract, taking advantage of trading characteristics of those unique options, the call or the put. Call if you're bullish, put if you're bearish. The debit spreads, so the idea that you want to offset the cost of your long options position by utilizing a spread strategy. We can look at directional condors, which is just a combination of a debit spread and a credit spread. We could do a directional butterfly, which is the same consideration, credit spread and a debit spread together. The difference between the two is just the selection of the center strike prices. We could also purchase straddles or strangles, which are the strategies that involve simply buying a call and a put at the same time, not so much to focus on a specific direction, but to more importantly take advantage of a stock that has the potential to move in any direction. So those are just a few. Protection, we could go long the stock and buy a put option as protection. If we are short the stock, so if we wanted to take a bearish stance on a stock, we could sell the stock short and purchase a call option for protection, or we could utilize a caller strategy, which is long the stock, sell a call, which would be the traditional covered call strategy, use that call premium to purchase a put option. And then finally for income, credit spreads, iron condors, iron butterflies, covered calls, and put writing. Now, again, these are, you know, I've thrown a lot of different strategies at you, and so tonight's or this afternoon's, you know, objective is not really to get into great detail about these specific strategies. As you guys continue to join us within these sessions, we're going to hone in on specific strategies and give you real solid, detailed overviews and examples of how you'd use these different strategies. But recognize the point of this slide is really to understand that it's not just as simple as buying a call or a put. When you become more experienced, you have an entire library of different strategies that you could call on in any different market environment to meet your objectives. So the biggest consideration with each of those strategies is that there are very unique considerations, such as the risk-reward proposition of the strategy itself, the impact of time depreciation, and that's a very important one, because as the option buyer, we have to recognize that that time depreciation variable is something that we are fighting every single day that we are in the position. So we want to make sure that we respect that and we manage accordingly. The impact of implied volatility changes, which we're going to touch base on in a little bit, but the recognition that on any given day, implied volatility can contract and expand, and that's going to impact the value of the option premium regardless of what the underlying stock is doing. Commissions as well. Again, you know, depending on your account size, the strategies that you're utilizing, the commissions are going to become a consideration, and the more we call them legs to a strategy. So when you do multi-leg strategies, you can be the buyer and seller of various contracts at any given time. So the more legs involved in a strategy, the higher the commissions, and so you want to keep that take that into consideration as well, and also the complexity of the strategy. So, you know, I always suggest that when you're thinking about trading options or utilizing options, think about it like flying a plane. So it's one thing to get the plane in the air, but recognize the most important consideration is how you're going to get that plane back down on the ground. And so certain strategies are more complex, and while you may be able to enter the position into the market, you want to understand how to manage it appropriately, and then how to offset that position when it's time to either cut your losses or to ultimately and ideally lock in your profits. Again, the reality of you know, these different strategies is that each one will perform differently depending on market conditions. When we start to combine different option contracts and calls and puts together, and being a call buyer and a put or a call buyer and a call seller at the same time, we want to recognize that we, in fact, alter the way that that position or strategy is going to perform when the stock goes up or down, or when time passes by, or when volatility expands and contracts. So we want to first make sure that we assess the market conditions and determine our objectives. We want to make sure that we research the available option strategies. So once we've assessed the market conditions, we know what we want to accomplish, what strategies will help us meet those objectives, and then create a plan to manage the positions. So before we actually ever click the buttons and you know, get that plane off the ground, so to speak, what's our plan? How are we going to get into the market? How are we going to manage the position once we're in the market? And then ultimately, how are we going to get out of the market once we've met our objectives, or once we feel that perhaps you know, we're on the losing side of it and it's time to cut losses. So once you've done all of that, then you want to recognize that even executing the trade can also be a little challenging as well, particularly if you come from a background where you're used to buying and selling you know, shares in your favorite stock or ETF. It's a pretty easy transaction that takes place, but when you start doing strategies that are combined with one another, there is a certain, I won't say challenge, but you need to have a certain understanding of just what it is that you're doing to execute the trade, so that it is actually in the market the way you want it to be in the market. And so I think probably the one that is also most overlooked in this particular component of the presentation is the idea of managing expectations. I think that there's oftentimes a misrepresentation of the options market when it comes to just the amount of leverage that's afforded to the investor, and the potential to make, you know, these 100 times and 100%, 200%, 500%, you know, of your capital or you know, returns. And while that potential is there, we want to recognize that when we start integrating different strategies, the combinations will then influence the outcome of the position. And so under certain circumstances, the stock may make a significant move, and you may look at your returns and say, well, that's not what I expected. But we want to recognize that it could be because of the way that you positioned the strategy that you utilized. It might be because of the passage of time. So we want to be realistic about our expectations, and recognize that, you know, the options market is not a get rich overnight market. It is a market that's to be respected. It is a market that gives us a lot of opportunities to do many different things with our capital, but we need to manage our expectations accordingly, and more importantly, manage the risk and understand the risks associated with each position. And if I just kind of circle back here, buying bargain options, it's kind of a more I guess politically correct way to say cheap options. But I remember when I first started trading options, I was looking for cheap options. I had X amount of capital, and which option can I buy the most of with the amount of capital that I had. And, that tends to be the mindset of a lot of people, that cheap is better because I can buy more of them. While you do absolutely leverage your capital, by purchasing bargain options or what would be considered to be bargain options relative to other contracts that you might be looking at, we want to recognize that they are cheap, or they appear to be bargains for a reason. Now, one of the considerations is out-of-the-money options. Now, an out-of-the-money option, for those of you that don't have a background in some of the options basics, would be, let's say the stock is at $20 and you are looking at an option, call option contract at the $30 strike price, which means that it's $10 out of the money. In other words, the stock has to move from $20 to $30 in order for that option contract to to have a value on expiration. And so we want to recognize that options are priced based on the probability of being in the money on expiration. So in other words, we want to recognize that options are about rights and obligations, and the strike price that we select, that strike price represents the price at which the option holder has the right to own the stock or sell the stock if it's a put. Now, the idea is that the closer the strike price is to the current stock price, that would be considered at the money. The further away would be out of the money, and then if the stock price is in fact above the strike price in the case of the call, that would be considered in the money. So it's all about probabilities. Is this option going to have a value on the expiration date? Because remember, unlike stocks, options have a day of reckoning. So when we look at choosing a particular option contract, we recognize that that expiration date is the day at which either that option is going to have a value because the stock has moved, and you'll have to make decisions accordingly, or it's going to be worth nothing because the stock has not moved. And so the probability of that option contract having a value on expiration has a direct influence on the value of the contract. So what we need to do is we need to, if I'll go back there, sorry guys, I got a little ahead there. What we need is we need to learn to select the strike price that's appropriate once again to meet their objectives. Now, I've got a little bit of an older example here. Those of you that follow Research in Motion or BlackBerry will recognize that it is not near the $14.50 level here. This is in fact a snapshot that I used back just ahead of earnings, actually back in June. But the principle and the consideration is still the same from the perspective of the pricing of the option contracts. So if we take a look at the chart here, or the little table here, what we'll recognize is that if we look at a September expiration strike price at the $12 mark, that's actually considered to be an in-the-money option contract because the stock is currently trading at $14.50. You have the right to own it at $12, and you'll recognize that the premium is priced accordingly. Now, that premium at the time was listed for $3.15. The delta, which is a term that if you're an aspiring options trader, you're going to want to get familiar with, the delta is how much that option contract should increase in value with every $1 increase in the underlying security. So I'll repeat that again. It's how much that option contract should increase in value for every $1 increase in the underlying share value. So you'll see that in-the-money call option in this case, with the $3.15 premium, has a delta of 0.80. So that is reflecting 80 cents basically. So the in-the-money option contract has a high delta. Now, what this in fact means, though, is that while we're paying a higher premium, I want you to look at the break-even points, because this is where a lot of times, again, novice option traders, aspiring option traders kind of fail to recognize the importance of, and that is that your break-even point on the position is the strike price, in this case the the $12 plus the premium. So what this is suggesting that is on expiration, which is the third Friday of September, the break-even point for that in-the-money call option is $15.15, because we add $3.15 to $12, and you'll recognize that the stock has to be at or above $15.15 for that position to break even. In other words, the premium will maintain its value. If we take a look at the September 14 contract, it's actually slightly in the money, but I use that as basically an at-the-money example. Premium was listed for $2. The delta is 0.60, so 60 cents. You'll notice how that at-the-money option contract has a lower delta. And your break-even point is 16. So you're paying less, but the stock actually has to move more for you to break even. Now, finally, we go to the 16 strike option contract. You're paying, once again, significantly less. The delta is less, and your break-even point is greater. So the benefit is you're risking less capital, but the stock has to move more significantly in order for you to meet that break-even point on expiration. Now, you don't have to hold the position till expiration, but what this is reflecting is probability of having value on that expiration date, and that in-the-money option contract has a higher probability than the at-the-money, which has a higher probability than the out-of-the-money. And we would use any of these, again, based on our trading objectives. So, for example, if this was ahead of earnings and my intention was to take advantage of a possible spike higher, but there was the uncertainty of an earnings report, well, I'm going to choose the one that's going to risk less capital, because the option premium, when we're an option buyer, we are actually risking only the premium we've paid. So in this case, if I bought that 16 strike call option, I'm only risking $1.20 per share, which means that the earnings report could be bad, and ultimately my maximum risk exposure is $1.20, which I would recognize on the third Friday of September if I in fact decided to hold a position for that length of time. So again, it's just an example of why you may consider one over another based on the circumstances. But here we have just a chart, once again, ahead of earnings. This is an interesting, not to get into a technical pattern here, but this kind of price action here demonstrates indecisiveness. So if you happen to see that forming on your favorite stock, it's always good to take a look and see whether or not they have earnings or some sort of pending announcement, because what it's suggesting is that the bulls don't want to take it higher, but the bears don't want to take it lower, and so you get this sideways coiling action here, which generally yields a very substantial move in either one direction or another. But in this particular example, we were looking at the share price sitting at $14.50, and I just wanted you guys to see a visual representation of the break-even points, because even though we're paying more for that 12 strike, the break-even point is $15.50. If we go to the 14 strike, you can see that we're paying less, but the stock has to move that much further. And then once again, if we go to that 16 strike, we're actually paying less even still, but the stock has to make a move even further. So understand, it's all about probabilities. You're paying more for the 12 strike because at the time there was an expectation that that stock had a high probability of being above that $15.15. Versus the 16 the 14 strike, and then the 16 strike. So again, it just gives you a little indication that all is not always as it seems. Options are priced because of probabilities, and there's a reason why they're valued as such. So we want to consider that out-of-the-money options are composed of time value only, and time depreciates to zero at the end of expiration. So an option contract that has no intrinsic value, has no exercisable value on expiration, is going to expire worthless. Out-of-the-money options will have a greater return during a move that is very quick and very volatile. So where might you consider an out-of-the-money option contract? Maybe around an earnings report where you don't want to put up a lot of capital and your expectation is that the earnings may be impressive and surprise, and then you're going to get that substantial move. But we want to recognize that the probability of the options expiring worthless is high if that move does not take place. Okay, at the money and in the money options are more expensive, but they offer the investor the potential for intrinsic value. In other words, they have a higher probability of having a value on expiration. Not that we're going to hold all the way until expiration, but we want to recognize that it puts the probabilities a little bit more in our favor. In fact, my own personal approach is at the money option. So when I'm trading a directional bias, and again, this is not a suggestion that it's appropriate for you, but for me, I like to use that happy medium at the money option contract. I don't want to pay the substantial premium associated with an in the money. I don't want to do the long shot consideration of the out of the money. I like that at the money option contract. So again, that just gives you some indication as to how I would make my selection, but the important consideration is what is your objective when it comes to what you're looking to accomplish. The other consideration, which also has everything to do with probability, is the expiration month selection. Short-term options are less expensive relative to longer-term expiration dates because they have a higher probability of the option expiring. So in other words, we want to recognize that the less time we give a stock to make a move, the higher the probability it's not going to make that move within the time frame. So in other words, let me just rephrase that. The longer time we allow a stock to move, the higher the probability it will do so. And as a result, the options are priced accordingly. So what we want to understand is that when we look to purchase an option contract, we are in fact really considering how that option contract fits on this it's a time depreciation. Just a little bit of time depreciation curve, and really it's just to illustrate that when we go 6 months, 9 months, 12 months out, the rate of time depreciation is in fact a little slower because the market steps back and recognizes that hey, there's still lots of time left, the stock can take a little detour, but there's a reasonable probability that it's going to make a move within that time frame. But as we start to get closer to expiration, you'll notice that the rate of time depreciation accelerates. And so what happens is the market starts to realize, well, wait a second, that stock, there's no way that stock's going to make a $5 move in the next 3 weeks because it hasn't made a $5 move in the last 3 months. And so the premium will lose value because of its the probability of it expiring worthless. And so once again, we want to find that happy medium. What are our objectives? Remember that we can buy and sell options at any point during their expiration cycle, and we are not required as the option buyer to necessarily hold them until expiration. And the longer you hold the option contract, the faster that time depreciation is going to be eating away at your potential profits. So as we move forward here, if the slide changes, just bear with me. What we want to recognize is that when we're looking at less expensive option contracts, we need to manage those positions accordingly because they are less expensive for a reason. Now, purchasing longer dated option contracts are more expensive, but they ultimately allow the investor or the trader a little more time for the forecast to play out. And understand that you don't have to hold the option contract all the way until expiration. You're just buying a little bit more time to weather the fluctuation of the share value, particularly in the current market environment where we tend to have a lot of volatility, and on any given day you can see some fairly substantial swings. So if you give yourself a little bit more time, you have the potential to profit ideally from your directional bias. Now, again, under any circumstances, however, you can close that position anytime before expiration to lock in your profits or to cut your losses. And that's very, very important to consider. It's all about taking action. Now, this next one here, guys, the ignoring implied volatility. This is a very, very, very important consideration that I think is often overlooked. And if I were to rank, it as far as its level of importance, I think that it would be right up there in the top 3. We want to understand that there's 2 types of volatility that we reference when it comes to trading options. The first is historical volatility, which is a reflection of the past realized volatility. So how much has the stock moved above or below its average price? So it's a measure of the average deviation from its average price. And so what happens is that options will traditionally trade based on this historic volatility, but every now and again the option premiums will adjust based on the market's expectation of future volatility. And so what we want to recognize is that implied volatility, it's the pricing adjustment for risk. So in other words, a stock may have a specific historic volatility, but if there's some variable that is on the horizon, let's say company earnings, which is an unknown variable, and it could certainly send the stock in one direction or another, pending announcements or mergers or macroeconomic events, so just sort of the general market conditions. In fact, anybody that's following, obviously the markets at this point will recognize that, there's some considerations for risk, and so under those circumstances, you can kind of think of options, for lack of a better word, like an insurance policy. And so if you think about your own insurance policy, when you represent risk to your insurance broker, they're going to raise your policy. Doesn't mean you're going to get into an accident necessarily, but the potential is there for it. And so we want to understand that that same consideration is factored in to the options market. And the challenge is that implied volatility expansion and contraction will influence the option price even if the stock does nothing. So one of the biggest and most common considerations that we see when we're chatting with our members and such is that they really like the idea of playing an earnings report, and they look at a common strategy, which is a straddle or a strangle. So the idea of buying a call and buying a put at the same time. But what we want to recognize is that ahead of an earnings report, particularly if you just buy those options just ahead of the earnings report, it's kind of like buying hurricane insurance when the hurricane is just about to hit your house. The fact of the matter is those premiums are going to be very expensive. And what happens is if you buy those option contracts when they're at their most expensive, if the stock does nothing, what happens is that you get a contraction of implied volatility, and even though the stock did nothing or maybe even moved in your favor a little bit, the option premium can lose value. So what understanding implied volatility versus historic volatility does is it helps the investor manage expectations and make better contract and strategy selections. So, for example, if I look at a stock and I can see that the implied volatility of the options contracts is higher than the historic volatility. So in other words, the market is pricing in a substantial move greater than what the stock has been doing historically, then I'll look to, let's say, a spread strategy. I'll look to implementing a bull call spread or a bear put spread to help offset that expansion of implied volatility. So it's just one way that you can use this little tool, these 2 variables, to help make a better decision when it comes to selecting your strategy. The other, and it kind of ties in with just what we've been talking about, disregarding earnings and dividend payments, particularly when we have a directional bias on a particular stock. We want to recognize that option premiums will increase when earnings are about to be announced because of that increase in implied volatility. what happens is, number one, demand for the options increase because you've got shareholders buying put options to hedge risk. You've got market makers, buying and selling call options to hedge their, their risk because of the fact that they're on the other side of the transactions. You got all sorts of activity taking place within the option contracts, which ultimately inflate the value of the premium. And so what happens is that you, as the option buyer, have the risk of paying overpaying for the option contract, and then ultimately getting caught in the contraction of implied volatility, when the earnings reports have passed. So, the idea is that the expectation is the stock is likely to be volatile, but it is uncertain as to which direction. So the option contracts premiums will increase according to that uncertainty. Now, here's a typical mistake. Again, I'm going to go back to utilizing that RIM example, but the investors believe that a stock is going to make a significant move, let's say lower on earnings, and they wish to buy a put option to appreciate, but does not realize that the implied volatility has been expanding, making the option expensive relative to its historic levels. So when we take a look at research in motion now, obviously, RIM actually, it's not RIM, sorry, BB in this case, BlackBerry, dropped substantially on those numbers. But what I wanted you guys to recognize here is, and this is a snapshot of an options chain as it's reflected on the Montreal Exchange website. You'll see here that the 30-day historical volatility of the stock is 32.89. So that's just basically reflecting how much the stock has been moving above or below its average price over the past 30 days. And if we think back to that chart, the swings have been substantial, but very much range-bound. Now, if we take a look at what, let's say, a 15-strike put option is worth, and not even necessarily 15-strike, any of these option contracts that you can see highlighted by this red box, you'll notice that the historic volatility is 32.89, but the implied volatility variable is sitting at 70%, 94%, 96%, 88%, 125%, 135%, and the same goes. The same would go for the call side as well. So it's just very important to recognize that if you're looking to take advantage of an earnings report, you want to make sure that you pay close attention to that implied versus historic relationship, because that may alter your desire to even take part in it. And if you are anticipating on taking advantage of an earnings report, do it several weeks in advance before that implied volatility premium starts to get factored in, because in fact you can make money from an expansion of implied volatility. So if you buy options when implied volatility is low, not only do you have the opportunity to profit from a move in the underlying stock, but also you can profit from an expansion of implied volatility. So very important to consider that if you're looking at playing these earnings. So again, the risk is that if implied volatility contracts, the option premium will drop in value, and that means that the stock could move in your favor, but not sufficiently enough to compensate for the drop in implied volatility. So you may in fact be correct in the forecast, but ultimately incur a loss because of the option strike price selection. So that is something that's controllable by you. And this is one thing that I always really try to reinforce, is that, when we're dealing with the capital markets, whether you're buying stock or whether you're utilizing options, there are so many variables that are outside of our control. What that means is we have to pay extra attention to the variables that we can control to put the odds more in our favor. And one of the important ones is just recognizing these pricing variables here that we're talking about. And so earnings also represent a significant amount of uncertainty in the pricing of the stock. And so what we want to recognize is that if all known information is priced in ahead of earnings, there is the potential for a surprise on new information. And so this is why you also want to recognize, as I was showing with that research in motion or that BlackBerry chart, you've got that sideways triangle or that coiling price action because the market didn't really know what to expect. And so the challenge with playing an earnings report is that the stock is trading based on all known information. And if you just pick a directional bias on an earnings report, you want to recognize that there could be a little surprise in the case of research in motion or BlackBerry, and it could be in the absolute opposite direction as what you anticipated. So you also want to consider that as a bit of a risk when looking to take advantage of earnings. Now, when it comes to dividends, share values are adjusted lower by the amount of the dividend on ex-dividend date, which may impact the value of the option contract. The stock dividend is one of the 6 option pricing variables, and I'll tell you, it's kind of embarrassing to admit, but I remember when I first started trading options, and I was looking, as we all do, for that dependable, opportunity in the market. So I thought, okay, well, if I know that a stock is adjusted lower by the amount of the dividend, why don't I buy a put option just before the dividend on ex-dividend date, and then when the stock drops in value, my put option will go up in value, and hey, I'll make a little bit of money on that. But again, as I started to, as I paid my tuition and I started to look a little bit more closely at this variable, the recognition was that's not how it works. It's already priced in. So even though the stock drops, you want to recognize that it's really not going to have that much of an impact on your option contract unless other market forces push the stock down even further. And so you want to understand also when dividends are being issued, because you could be going along managing your options position, and all of a sudden you take a look at the stock and the stock's made a big move, but you're not seeing it in the option contract. You'll want to know that the reason is likely because it just went ex-dividend and issued a dividend, which, as we know, adjusts the share value down. The other consideration, very, very important for those of you that are aspiring to utilize the covered call strategy, or any option writing strategy for that matter, there is the possibility of early exercise before the ex-dividend date. What happens is that if the option time value component of the premium is less than the dividend being issued, then what an astute trader or investor will do is, they'll buy the option contract for that low time value. They'll exercise their right, they'll take the stock, and then they'll receive the dividend. Now, we're not talking about the likelihood of any substantial profit, but it's a way to what we would call scalp the market a little bit, grab a little bit of premium off of that particular anomaly in the market. So again, you may be managing a covered call portfolio, and all of a sudden, and that's where you own the stock and you sell a call option. That call option, you collect a premium that creates the obligation for you to deliver the shares at a certain price. Understand that before expiration, somebody may decide to take those shares from you. Now, you always get the premium, and you always get the strike price that that you sold the option at, but you will not get the dividend. Somebody else has taken the stock and will get to keep the dividend. And no, just a quick question here: do we settle the covered call before ex-dividend? Not necessarily. Because it's not guaranteed that you are going to be assigned. But it's very much because not everybody is going to, not every call option that is short ahead of ex-dividends is going to get assigned. But it is important just to understand that there is the potential to, for that to happen. To be forewarned is to be forearmed, and you're not going to wake up in the morning with a surprise. You will have known that the stock's going ex-dividend, and you will be fully expected for that to happen. But it's not necessarily a guarantee that it is going to happen. So again, the call buyer in the case of the of this particular scenario may feel that there is a financial benefit of receiving the dividends that is outweighing the benefit of continuing to hold the long call. But remember, if you set out with a covered call position and your expectation was to receive, you know, X amount return in premium and X amount return based on the stock moving towards or hitting that strike price, recognize that you're still going to get those returns. You're just not going to benefit from the dividend being paid out. So just important to keep in mind. Waiting too long to close your positions. Typical investor's mentality. And again, I don't want to paint a broad brush here, but the typical stock investor's background is the approach that tends to embrace the old buy and hold mentality, which is, yeah, I was hoping to make a profit today, but you know what, we'll see what happens tomorrow, and so on and so on and so forth, and so goes the hopes and dreams of, you know, BlackBerry shareholders and so on and so forth. You know, the idea is that when you own stocks, you know, you can always hold on to the shares because it's not a realized loss until you sell the shares, and as long as the stock stays in business, you know, you have the potential for the shares to turn around and go in your favor. What happens is a new option investor fails to realize that the time depreciation is consistently degrading the option premium. That's as the option buyer. And so the more time that passes, the faster the rate of time depreciation. So we talked about that a little bit when we were looking at that time depreciation variable. And so the more the time value depreciates, the greater the stock has to move in favor to compensate. So what ends up happening is that a lot of times, you know, investors will you know, be making a decent profit, but then they'll expect that they should be making more, and the stock doesn't move. And so the stock doesn't move, but time's always passing by. So what was once a decent profit on a Tuesday is not quite as attractive the following week, and so on and so forth. So recognize that the longer you wait, the more the stock has to move to compensate for the time depreciation. That lowers the probability that the option will be in the money on expiration, and then ultimately the option has the greater potential of expiring worthless. So we need to make sure that we recognize that and we take action accordingly. We don't just revert to the buy and hold mentality, which is that, oh, I've got all the time in the world to sit back and let this stock you know, go in my favor. And that falls into the consideration of ensuring that you have a plan in place for exiting your position, or ultimately a repair strategy for you know, adjusting your position ahead of expiration. So the old saying goes, of anybody that's been trading and investing, you know, has always heard, I'm sure has heard the saying in the past, plan the trade and trade the plan. And the idea is that, you know, what happens is failure to plan generally results in an investor who will make an emotional and often irrational decision. So in other words, you know, once you're in the trade, once you're invested in the opportunity, and you've got money on the line, it becomes a little bit of a different consideration, and all of a sudden emotions start to creep in, and we start to cling to maybe that idea of hope. You don't feel in control, and you know, this is the other consideration as well. You know, a lot of times, you know, an investor will just jump in, or an option trader will just jump into a trade, but then it's kind of like the idea of, yeah, I got the plane in the air, but uh-oh, how am I going to get it down, or where's the airport, or do I have enough gas to get to where I need to go? You know, you need to have that plan, because when you have that plan in place, you will be in control. You'll know where you're taking profits, and you'll know where you're cutting losses, which in turn helps to filter out some of the emotional and irrational behavior that oftentimes leads to the failure of an aspiring self-directed investor or trader. And, you know, ultimately what happens as well is that if you don't have a plan in place, many times profitable trades will turn into losing trades, because again, we always, expect that when a stock is going in our favor, that it will always keep going in our favor. But the fact of the matter is, it doesn't. And you add another variable in there when you utilize options because of the time depreciation factor. And so what we want to recognize is that if we have specific targets based on the time that we've allocated for the position, then we're going to be taking action as those targets are met, and that's going to help us lock in our profits and help us avoid these profitable trades turning into losing trades. And the idea, again, holding on to losing investments, clinging to hope. We often kind of laugh about the idea of, you invest in a stock and you pay, $50 for that stock, and then it drops to 45. Well, if you liked it at 50, you're going to love it at 45. And if you like it at 45, well, you're really going to love it at 40. The idea that you just, you can't psychologically admit that, okay, the stock is not going in your favor, and then you turn around and you look at the dollar cost averaging scenario. But understand that is not the way that we manage risk in the options world, because again, we have that consideration of time depreciation, and it's that old saying, don't throw good money after bad. Manage the risk. Trade the plan. If it's not working for you, step aside and find another opportunity. Hang on to the ones that are working, and get rid of the ones that are not. I always look at the idea of creating a roadmap, and it's kind of a silly way to look at it, but I look at, and I'm very much a technical analyst, so I believe personally that all known information is priced into the stock, and so that ultimately, even if there are people that know more than I do about a particular company, there's a high probability that they're buying on that information, which means that the price action is going to reflect that. And so what we could do using a price chart, or it doesn't matter what it is, but you create a roadmap. You would not leave your house going to a destination that you've never been to before without at least having some sort of a plan or a map in place, so you know that you're heading in the right direction, and so that you know where you need to adjust if you happen to get off of the route that you planned out. So investing has to be the same way. Stay on that path if you're on the right path. If the stock is moving in the direction you anticipated, then you stay on that path. But if that stock takes a little bit of a wrong turn, you need to adjust accordingly. So set price targets when action is to be taken, so that you are preserving your capital, so that you're managing risk, and furthermore, you're maximizing your returns. And as I said, you can use predetermined technical signals such as support and resistance levels or other indicators to filter out the emotional side of it and give you technical clues for you to take action on. Compromising your risk tolerance to make up for past losses, that goes back to the old dollar cost averaging scenario. Losses are a part of trading and investing. I cannot stress this more importantly. You will never, ever, ever achieve 100% accuracy, and if you are, and you do, come see me at my office. I'd like to learn your strategy, because we're dealing in a business of probabilities, and so that means that we want to recognize that we manage for losses when we're wrong, and we capitalize on the profits when we are correct. Losses are part of the trading business and investing business, as they are part of any business. And so when we look at taking more risk to compensate for a previous loss, we are making an emotional decision. You guys may have heard of that, the revenge trading sort of idea, where you've lost money on a certain stock, and you get you've got to beat this stock. Well, the stock doesn't care. The stock doesn't care whether you win or lose. It's going to do what it wants to do. So we want to filter out these emotional decisions. We want to know our risk tolerance, and we want to invest within it, because when we know our risk tolerance and when we invest within it, we're we're comfortable in the positions. We can sleep at night. You know, we know that we can wake up on any given day, and a substantial move against us is not going to prevent us from retiring happy or from paying our mortgage or for buying groceries. So know your risk tolerance and invest within it, and follow an appropriate plan designed by you so that you can avoid falling into an emotional trap. And we are getting into the end here. The bottom line is, if you are looking for more information, there's a lot of resources available on the Montreal Exchange site. There's blogs that both myself and my partner Patrick Sresna, as well as our other industry peer Richard Croft, will post on, so that's optionmatters.ca. Lots of videos and webinars, particularly if you're somebody that has needs a little bit of a background on the options market in general, although I believe we're going to be looking at providing you guys with some of that content in upcoming webinars, but it's a great way to get a jump start. There's trading guides, there's calculators, there's simulators, so there's lots of fantastic resources there. You can find more information at m-x.ca, as well as lots of videos, hours and hours and hours of videos at m-x.tv as well. So I don't know if Sarah's still on board to moderate here, but Sarah, I'll pass the mic back to you, and I'll let you take a look at some of the questions if there are any. And I know we hit the quarter after mark here, but I'm happy to answer questions as they roll in.
Okay, that's perfect. Thank you so much, Jason.
Pleasure.
So due to the high volume of participants in today's webinar, we may not have the opportunity to address all of the questions. If there's something that does not get answered of yours and you'd like to follow up, please contact BMO Investor Line. To ask a question, please hover to the top of your screen. A toolbar will appear, and then click the Q&A button.
Perfect. So I'll just hang on, and I'll just maybe wait for your cue, Sarah, to read out the question that comes through, and
sure.
And we'll just tackle them accordingly. If not,
okay.
you know,
give me a moment, and I'll have a look at the question. Thank you.
No worries. And for the benefit of those that are still online there, you know, it's a lot of information, and it's, you know, the challenge sometimes with this particular presentation is that it kind of forces everybody to step back a little bit, and I hope that I didn't discourage anybody from pursuing a, you know, integrating options into their portfolios. You know, I cannot, you know, I cannot stress enough how powerful these strategies are. Now, again, there are risks associated with the various strategies that I highlighted on that one slide. It's up to you to really assess what's appropriate as far as your objectives, but understand that once you grasp these different pricing variables, and yes, the learning curve's a little steep, but I can tell you it opens up an entire new world for you know, for the you know, for the investor, you know, in terms of income generation, portfolio protection. Now I do sound like a marketing representative for the exchange, but recognize I'm independent. I'm contracted by, but trade independently myself with my partners. So you know, I can just tell you from my own experience that it opened up a whole different world when it came to just being able to take advantage of different market, you know, environments. And if you spend a little bit of time, and it's like anything else, it's, you know, you got to spend the time, you got to dedicate, you know, a little bit of time, and anything worth doing is worth spending the time at, and it doesn't happen overnight. So I hope, if anything, maybe inspired you guys to take things to the next level and join us in the next webinar.
Okay, so I do have a question ready for you.
Sure.
Can you please talk about cover call for income, how
Yep.
to optimize the profit, and how to pick the strike price?
All right, so you know, and ideally, moving forward, just keep an eye on the webinar schedule because we do have an entire presentation dedicated to income generation. But very simply put, you know, the covered call strategy is a very powerful strategy for increasing yield in your portfolio, and the idea is that you own the stock. And you sell off a call option that obligates you to deliver the stock at the higher price. So really, the strike price that you select is going to be dependent upon your objectives and your outlook. If you are looking at generating as much premium as possible and you're not concerned so much with the upside of the stock, then you own the stock and you sell a call option at a strike price close to where the stock is trading. The probability of having to deliver the stock is high, but you collect more premium initially. If you felt that there was increased upside, you really wanted to benefit from the stock pushing higher, then you would sacrifice some of the premium, go further out of the money, allow more upside potential, but collect less premium. So it really, it does have everything to do with what you're trying to accomplish and what your objective is with the stock. Now, the one thing that I will preface both of those little examples, or not preface, but one thing that I will suggest is that you want to recognize that the risk is associated with the stock. So you want to be very comfortable and confident that the stock is trending to the upside, maybe consolidating, but not demonstrating any bearish characteristics, because the loss that you would incur on that stock position is going to be what you paid for it minus the premium that you've collected, but anything below that premium becomes a loss. Now, this becomes very, very powerful because if we could generate, let's say something very conservative, let's say 1% a month, which is, you know, very powerfully, and that's just suggesting that the stock does nothing or is moving to the upside. After so many months, you've now collected X amount of premium. That premium now provides a buffer for your portfolio in the event that there is a correction. So what it does is it mitigates market volatility. So you're collecting premium consistently in good times. It's increasing the yield, you know, increasing the returns in your portfolio. In bad times, it's creating a hedge for you. So, you know, without going into another 1-hour presentation, hopefully that gives you a little bit of insight.
Great, thank you. The next question, do you have a good options trading book to recommend?
Well, me personally, I've always been a fan of Macmillan, and Macmillan has a book, Options as a Strategic Investment, and it's just a great big thick book that has a lot of different strategies and insights. So, you know, I've got that on hand. The one challenge that I suggest that people consider is that, you know, it is very, very thick, and you know, in fact, it's actually been labeled the Bible of options trading because there's so much information in there. Be careful because a lot of it is very advanced. A lot of it is not necessarily applicable to, you know, the average, you know, options trader. So what I suggest is, you know, take advantage of some of the resources that the exchange has because, you know, we've tried to really simplify it. Also, step back and figure out what you want to accomplish. What's important to you right now? Is it income? Is it protection? Is it leverage? And then follow the path that leads you down learning those specific strategies. So, you know, rather than trying to learn everything all at once, you know, focus on what you want to accomplish and start down that path, and hopefully that helps out.
Great. I have another one ready for you.
Yep.
Do you have any thoughts as to why the TMX bid-ask spread is wide compared to the U.S. market?
It has everything to do with the liquidity and volume in the United States. There's you know, well over, there's 6+ options exchanges. There's 3,000+ options eligible stocks. And so what happens is you've got an environment where, you know, the United States is, you know, it's essentially the global hub for options trading. And so, you know, it's kind of like, you know, I always look at Walmart, let's say, versus a boutique store. Walmart, you got a lot of traffic, so they can keep rolling back their prices. They can keep you know, they can keep their prices low because they have a lot of traffic. In Canada, we have one exchange, and we have, we have 300 plus options eligible stocks, but we don't quite have the global exposure. And so this is why, you have those wider bid asks. And so what I suggest is you focus on, the stocks that are more highly traded. If you look at any of the Canadian banks, if you look at, BlackBerry, if you look at any of the, Canadian resource-based stocks, you get some favorable bid-ask spreads. And the other consideration is we're in Canada. So, if you trade U.S. options, you've got to consider currency conversion and currency risks associated with trading in that market. Not that I'm suggesting it's, not an appropriate market to trade, but also recognize that, if you hold a portfolio of Canadian-based securities and have done so for an extended period of time, integrating a covered call strategy utilizing, your holdings is very, very much obtainable on the Canadian side. But long story short, it has everything to do with the liquidity. The U.S. is a bigger market, Canada is a little smaller, and as a result, spreads are wider.
Okay, and we have time for one more question.
Sure.
Is a gain-loss in options a zero-sum trade? That is, when I get a gain, someone else loses?
Well, yeah, I mean, it is theoretically in the sense that the option buyer, let's say you buy an option contract and the option contract drops in value, then the option writer actually picks up that profit because they sold it at a premium. The premium is dropped, and as a result, they benefit. So, yes, it is a zero-sum game in that respect, but what I always encourage people to recognize is that people are buying and selling options for a variety of different reasons. So, for example, let's say I own shares of Barrick, and my intention is to buy a put option to protect those shares while I benefit from the upside. I look at that put option as a sunk cost. In other words, that's my insurance policy. So I don't care whether or not the put seller is going to collect a premium, because if the put seller collects a premium, that means my stock is going up. And so while it is a zero-sum game, what we want to recognize is that everybody is buying and selling options to meet different objectives and for various reasons. So that, at the end of the day, is the most important consideration. Why are you using that option contract? And if you're concerned about the risk associated with depreciation of the contract, then you got to manage your risk accordingly and close it out before you reach your maximum risk.
Great. Thanks, Jason.
Pleasure.
We will now wrap up the Q&A session. Thank you to all of the participants for attending today's webinar. There will be a follow-up survey that will pop up after you close the webinar screen. Please feel free to leave your feedback on our live webinar. We also will be posting a recording of today's webinar shortly on our Learning Center. Thanks, and have a great day.
All right, folks, thanks very much. It's been a pleasure. Thanks, Sarah.